15 minutes, and at the end, you'll be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and good morning or good afternoon, everyone, depending on where you are. I'm tickled today to be talking about the new Tax Act. I love the smiling snowman theme that we have as part of our webinar today. I think it works on several levels. Most of the country, as I understand it, is in a deep winter freeze, and so snowman seems to be kind of an apt thing. But the smiling snowman, I think, is a great indicator about how much fun the tax change is going to be for us. I think any change brings with it opportunity. This particular tax change brings lots of opportunities for our entrepreneurial clients and our high-income clients, and so that's probably going to be good for many of our businesses. And I guess the last thing is to stretch a metaphor about snow and cold. We've had a winter of uncertainty, or a pre-winter of uncertainty, with exactly what the tax law change might be, if there was going to be any. It turned out that there is one. And so we have the opportunity to look forward to the snow melt and the thaw and the spring of opportunity. So thank you for allowing me to stretch that metaphor, and let's get on with it, because we don't have a lot of time to talk about the new Tax Act. In fact, we're not going to get into a lot of depth. We're going to spend about 15 minutes. We're going to touch on some of the features of the new Tax Act that'll have the most impact on your business in 2018. If you don't get everything that I say, don't worry about it. Jennifer will send attendees a copy of our Life Live newsletter published for this month, which has in it a chart which compares the old tax law, the one that was active long ago in 2017 with the new Tax Act, and some of the main features, and so you can use it as a reference guide as we're going forward. I would also invite you to tune in again next month to the webinar in which we'll go over all the tax and relevant numbers for 2018 to our business. So you'll have an opportunity to kind of get some of this stuff today reinforced. So what are we talking about? We're talking about the Tax Cut and Jobs Act that was signed by President Trump on Friday, December 22nd. The process was hurried. The Senate and House versions had to be reconciled, and so there was a great deal of uncertainty and confusion as to what would actually be in the final version. As a political matter, Democrats were largely excluded from the process, and so what we have is a largely Republican bill, which changes the income tax rates in a major way for individuals and for businesses. It's a tremendous tax relief for many individuals and a lot of closely held business owners, particularly those in high income tax brackets. No matter what bracket our clients are in, most will see at least a little bit of an income tax reduction. There will be changes, there have been changes to the estate and gift and generation skipping tax rules that also provide opportunities and also changes those markets, I think, for us. So let's talk about these things. Let's talk about, first of all, the individual income tax changes. So 2017, we had 7 income tax brackets. In 2018, we also have 7 income tax brackets. So this is not tax simplification. We've got the same number of brackets. It's just that the rates in some of the brackets have gone down. And you can see for yourself the comparison. The significant change is that the standard deduction has been increased. What does that mean? The standard deduction is available to taxpayers who choose not to itemize their expenses. And so with the standard deduction essentially being doubled from just over $6,000 to $12,000 for a single taxpayer to just over $12,000 to $24,000 for married couple filing jointly, what that means is that more taxpayers will claim the standard deduction and will not itemize their deductible expenses. And so the value of itemized expenses for many of our clients will go down because many of those clients will be choosing to take the standard deduction. So the standard deduction is bigger. That's good. The downside is that it makes itemized deductions potentially less valuable. Personal exemptions have been repealed. And what does that mean? It means that a lot of taxpayers, if they were single, were able to claim a $4,000 deduction from otherwise taxable income for their personal exemption for themselves. They were also able to claim another $4,000 reduction of their taxable income if they had dependent kids. Those have been repealed. And so that means that for many taxpayers with who have a lot of dependent children, they might actually see their taxable income go up. Now, as an aside, a lot of these provisions are scheduled to sunset at the end of 2025. That means if Congress and the President don't make a change between now and then, things are going to go back to the way that they were. So we've got the kind of situation, if you can remember, in 2010 with the estate taxes, we've got that kind of situation here with regard to a lot of these provisions. So what will happen? We're not sure. Hopefully Congress and the President will get together again sometime before the end of 2025 and decide on something that might be more permanent. What will that look like? Of course, we don't know. We don't know who's going to be in control of the presidency and in control of Congress between now and then. So it's difficult to predict what might happen. So in any event, this is what we've got, at least for the foreseeable future. What else has changed? First of all, mortgage deduction is still available, although it is more limited. So if you're a taxpayer going out to buy a new home, you are limited to a $750,000 mortgage in order to be able to take a mortgage interest deduction. If you've got an existing mortgage that was in effect last year, you're still able to deduct what you were able to deduct before. But you can only deduct $750,000 on a new mortgage going forward. Interest on, state and local income taxes are still deductible for those who itemize, those who don't claim the standard deduction, but the aggregate amount is limited to $10,000. And so those are additional squeezes on deductions. The rule on the gain.
So originally we reported that the rules to qualify for the exclusion on sale of a primary residence have changed. Please note that the information on the slide on your screen is incorrect. The exclusion is still available if the taxpayer has lived in the primary residence 2 of the prior 5 years before sale. The exclusion amount is still $250,000 for a single taxpayer, $500,000 for married filing jointly.
The healthcare mandate penalty has been repealed beginning in 2019. So if you don't have required health insurance under Obamacare, your fine will be zero in 2019 and later. The personal alternative minimum tax exemption has been increased, meaning the AMT on the personal side will hit fewer taxpayers. And here's one that has gotten maybe a little less publicity. Used to be that you could recharacterize a Roth conversion up until the extended due date for the return for the tax year in which the conversion occurred, which is October 15th for most folks. That's changed. You can't recharacterize a conversion anymore. The deadline for doing that for 2017 apparently has passed, and so recharacterization of a prior conversion is no longer available. So people are going to have to think about conversions more carefully in the future. What does this mean as a practical matter? It means that most of our clients will pay lower income taxes. High income clients in particular are likely to benefit in a big way. Business owner clients, we'll talk about them in a second, are also likely to benefit in a substantial way. Low and middle income taxpayers may pay less, they may pay more, depending on the number of personal exemptions and some of the other factors. Could somebody pay more? Yes, if it's a large family with many dependents. If itemizing was a close call in 2017, if you've got somebody who's a candidate to buy a new executive style home of $1 million or more, the limitation on the mortgage interest deduction may cause them to rethink that, or may cause them to have to pay more in income taxes. And if you've got a taxpayer in a high property tax or income tax state, or both, the ability to deduct those taxes becomes much less, and so it may cause them to have to actually pay more in income taxes. So what didn't change for individuals? The Obamacare surtax of 3.8% has been retained. The same threshold, same rules as before. Capital gains and qualified dividend income tax rates are unchanged. We've still got 0, 10, 15, and 20% rates, and the thresholds for when those rates apply are identical to those in 2017. They are not tied to any new tax brackets, so we've got a mismatch between tax brackets and the threshold for for the dividend rates. What else has changed? The estate tax, gift tax, and generation skipping taxes have changed. The exemptions have been increased. The exemption is now $11.2 million per person, not married couple. That works out to $22.4 million for a married couple. So a 40% rate is still in effect for amounts in excess of the exemption, both gift tax and estate tax, as well as GST tax. And portability of the unused exemption is still the law of the land. That's also scheduled to sunset in 2026. Good news, in addition to the increase in the exemption amount, the step-up in basis rule at death has been retained. Now, I guess this is a good news, bad news thing for our business. In our business, the life insurance business, we've had the opportunity to talk about life insurance as a tool to pay for estate taxes that couldn't be avoided. The good news is that still works. Nothing about the Tax Act has changed the effectiveness of using life insurance in an irrevocable trust to pay for estate taxes. The bad news is that fewer people are going to have to worry about estate taxes with the increased exemption amount. So that needs to be part of what we think about as we make marketing plans for the new year. So the biggest changes really came on the business side. There's a brand new 20% deduction for the income of certain kinds of pass-through business. Proprietors, partners, S corporation shareholders are all potentially eligible. The deduction is available for a married business owner if the taxable income of that married business owner is less than $315,000. And so for our modestly successful, closely held business owner clients with pass-through entities like S corporations or partnerships or proprietorships, the value of this 20% deduction is going to be high. If they're over the threshold, their ability to claim the 20% deduction will depend on the kind of business that they're in. Most professional service businesses are not eligible if income is going to be much over the threshold. And it will, even up for other kinds of businesses, the availability of the deduction will depend on things like the owner's W-2 income and depreciable business assets. It's really complicated. I'm not going to go into any detail there. Just know that for a lot of our pass-through business owner clients, if they've got relatively modest business income, this is going to allow them to keep more of their money. If they're over the threshold, there's some question about that. For a C corporation, it's really all pretty good news. Used to be that a C corporation the income tax rate maxed out at 35%, including for personal service companies. That rate's been capped at 21% for C corporations, including personal service corporations. That's a significant tax cut. In addition to that, the corporate alternative minimum tax that applied to C corporations in the past has been repealed. The corporate alternative minimum tax had the potential to apply to life insurance cash value growth or death benefits at a rate as high as 15%. Now it's gone, and so that makes business-owned life insurance look that much more attractive. So to wrap this up, what does that mean? What does the new Tax Act mean? It means that high-income clients will likely have more after-tax money to invest. That's good news for us, particularly with regard to life insurance. Life insurance is paid for with after-tax money in general. If after-tax money is cheaper to keep, that's good and will allow our clients to consider the purchase of personal life insurance more. Life insurance plans within C corporations are more attractive, and that's because there's lower after-tax company money in a C corporation. It makes certain kinds of plans potentially cheaper to implement for our business owner clients, including key person life insurance, deferred compensation, which is paid for with after-tax company money, split dollar. We've seen a resurgence of split dollar plans in recent years that may help in split dollar's revitalization. And also for the owner of a C corporation to pay dividends to her or himself to buy personal life insurance, that may be more attractive, perhaps in some cases even more attractive than using a bonus plan for such implementations. So those kinds of things will need to be thought about going forward. There's an opportunity for us to revisit our clients' estate plans in light of the more generous estate tax and gift tax exemptions, maybe more opportunity to do things like sales to grants, family limited partnership planning, sophisticated gift planning in light of the more generous gift tax exemptions. Even clients that have perhaps used up their gift tax exemption in the past, in light of the fact that there's more available, there may be an opportunity for them to do more planning. Certainly, at a minimum, we've got an opportunity to go talk to our estate planning clients about what's changed and whether their plans still make sense. And then finally, for those of our clients perhaps who are skeptical that these changes will be permanent, whatever permanent means in Washington these days, and I think they'd be rightly skeptical about the permanence of these changes. I think it's an opportunity to talk about the changes with them for sure, but also to discuss ideas that are persistent, that are not tax sensitive, things like buy-sell planning, which is an idea that is always good to talk about. Things like estate planning, making sure the right people get the right stuff at the right time after a client's gone, without a focus on estate tax management. I think there's, everybody wants to make sure that their stuff goes to the right people after they're gone. And so it's still a good time, a good opportunity to talk to clients about that, and there are usually plenty of opportunities to talk about life insurance within that context. So there's lots. The conclusion, I guess, today is that there's lots to know about the new Tax Act. You've got lots of questions that you would like answered. Feel welcome to contact us if you've got specific questions that you'd like to sort out. Our clients certainly want to know what the effect of the new tax change might be. Let's go talk to them. Let's serve them with information. Let's help them solve their financial goals, solve their financial problems. The new Tax Act provides plenty of opportunities for us to educate, to serve, and to make a little money along the way. And with that, I'm going to turn it back over to Jennifer.
Thanks, Lennis, and thanks for joining us today. And join us next month on February 7th for 2018 By the Numbers, Key Numbers You Should Know. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for information about the services that Advanced Underwriting Consultants offer, including phone consultation and newspaper licensing, feel welcome to contact us at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.